Wall Street just got hit with a 1-2 punch. Middle East war signals are escalating. Critical inflation data is coming this week, and markets are scrambling for answers. If you are a beginner investor right now, you are probably feeling overwhelmed. The headlines are scary. The market swings are intense. But here is what you need to understand. This is exactly the kind of moment that separates informed investors from panicked ones. Let me break down what is actually happening and what it means for your money. First, let us talk about the geopolitical situation. Tensions in the Middle East have reached a critical point. Reports indicate potential military escalation involving Iran. President Trump has given Iran a 48-hour ultimatum to negotiate. This is not just political theater. It has real economic consequences. Why does this matter for markets? Because the Middle East controls a massive portion of global oil supply. When war risks rise in this region, oil prices spike. And we are seeing exactly that right now. Crude oil prices have surged dramatically this week. Brent crude jumped over 5% in a single session. West Texas Intermediate followed the same pattern. This oil price surge creates a ripple effect across the entire economy. Higher oil means higher transportation costs. It means higher manufacturing costs. It means higher prices at the gas pump for consumers. And all of that feeds directly into inflation. Now here's where it gets complicated. The Federal Reserve has been fighting inflation for 2 years. They have raised interest rates from near zero to over 5%. Their goal was to cool down the economy and bring inflation back to 2%. And it was working. Inflation had fallen from 9% to around 3%. But now this oil shock threatens to reverse that progress. Let me give you some historical context here. In 1973, an oil embargo caused prices to quadruple. That triggered a decade of high inflation and economic stagnation. In 1990, Iraq invaded Kuwait. Oil prices doubled in just 3 months. The US economy fell into recession within months. In 2008, oil hit $147 per barrel. That was right before the financial crisis. The pattern is clear. Oil shocks create economic pain. They force the Federal Reserve into impossible decisions. Do they keep rates high to fight inflation? Or do they cut rates to support a weakening economy? This is what Wall Street calls a policy dilemma. And markets hate uncertainty. Now let us talk about the inflation data coming this week. The March Consumer Price Index report is scheduled for release. This is one of the most important economic reports of the month. It measures how much prices are rising across the economy. Everything from groceries to rent to medical care. Economists are expecting inflation to remain around 3%. But here's the problem. Those forecasts were made before this oil spike. If energy prices show up strongly in the data, we could see a surprise. A higher than expected inflation reading would be terrible for stocks. It would mean the Fed cannot cut rates anytime soon. Higher rates for longer means lower stock valuations. It also means higher borrowing costs for companies, and that hurts corporate profits. We are also getting the March jobs report this week. This shows how many jobs the economy added last month. Strong job growth is normally good news, but right now, it is complicated. Too many jobs means the economy is running hot. That gives the Fed less reason to cut rates. Too few jobs means recession fears. That is also bad for stocks. So what is the market actually doing right now? Let me walk you through the price action. Last week, the S&P 500 fell nearly 2%. The Nasdaq dropped even more, down about 2.5%. Technology stocks got hit especially hard. Why? Because tech companies are valued based on future earnings. When interest rates stay higher for longer, those future earnings are worth less today. This is a concept called present value. It is Finance 101, but it is critical to understand. Think of it this way. If I promise to pay you $100 in 5 years, what is that worth today? It depends on interest rates. If rates are 2%, that future $100 is worth about $90 today. But if rates are 5%, it is only worth about $78 today. The same logic applies to stocks. Higher rates mean future profits are worth less. That is why tech stocks fall when rate expectations rise. Now let us talk about what professional investors are doing. According to recent reports, many are waiting on the sidelines. They are holding more cash than usual. They are waiting for what they call a better entry point. What does that mean? It means they think stocks could fall further. They want to buy at lower prices. This is actually a smart strategy during uncertain times. but it requires patience and discipline. For beginner investors, here's what you need to know. Market volatility is normal during geopolitical crises. The average intra-year decline for the S&P 500 is about 14%. That means even in good years, stocks typically fall that much at some point. We have already seen about a 7% pullback from recent highs. That is actually pretty mild historically. The key question is whether this is just a normal correction or something worse. Let me give you a framework for thinking about this. There are 3 possible scenarios right now. Scenario 1 is the optimistic case. Middle East tensions de-escalate quickly. Oil prices fall back down. Inflation data comes in softer than expected. The Fed signals rate cuts are coming soon. In this scenario, stocks could rally strongly. We might see new all-time highs by summer. Scenario 2 is the muddling through case. Tensions remain elevated but do not turn into full-scale war. Oil prices stay elevated but do not spike dramatically higher. Inflation remains sticky around 3%. The Fed keeps rates unchanged for several more months. In this scenario, stocks probably trade sideways. We would see a lot of volatility, but no clear direction. Scenario 3 is the bearish case. Middle East conflict escalates into a broader regional war. Oil prices spike above $100 per barrel. Inflation reaccelerates to 4 or 5%. The Fed is forced to hike rates again. The economy tips into recession. In this scenario, stocks could fall 20 to 30%. Now, I'm not here to tell you which scenario will happen. Nobody knows. Anyone who claims to know is lying to you. But I can tell you how to position yourself for all 3 scenarios. First, make sure you have an emergency fund. This should be 3 to 6 months of living expenses in cash, not invested in stocks, not in crypto, in an actual savings account. This protects you if scenario 3 happens. Second, do not try to time the market. Study after study shows that timing does not work for individual investors. The best strategy is dollar cost averaging. That means investing the same amount every month regardless of market conditions. If stocks fall, you buy more shares with the same dollars. If stocks rise, you participate in the gains. Third, focus on quality companies. During uncertain times, quality matters more than ever. What is quality? Companies with strong balance sheets, low debt levels, consistent profitability, competitive advantages that protect them from competition. For research purposes, you might look at companies in the Dividend Aristocrats list. These are S&P 500 companies that have raised dividends for 25 consecutive years. They tend to be stable, profitable businesses. Fourth, consider your sector exposure. Different sectors perform differently during geopolitical crises. Energy stocks often do well when oil prices rise. Defense stocks can benefit from increased military spending. Consumer staples tend to be defensive because people still need to buy food and household goods. Technology can struggle if rates stay high. This does not mean you should completely overhaul your portfolio, but it does mean you should understand what you own and why. Fifth, ignore the noise. Financial media makes money from clicks and views. They have an incentive to make everything sound urgent and dramatic. Most daily market moves are just noise. They do not matter for long-term investors. What matters is staying disciplined and sticking to your plan. Let me share a real example from history. In August 1990, Iraq invaded Kuwait. The stock market immediately fell about 15%. Investors panicked. Many sold everything. But by March 1991, the market had fully recovered. Investors who stayed invested were fine. Those who panic sold locked in permanent losses. The same pattern played out after September 11, 2001. Markets fell sharply. Panic was everywhere. But within a year, markets had recovered most losses. The lesson is clear. Geopolitical shocks create short-term volatility, but they rarely derail long-term investment returns. Now let me address the Federal Reserve situation more deeply. The Fed is in a very difficult position right now. Their dual mandate is maximum employment and stable prices. Right now, employment is strong. The unemployment rate is still below 4%, but inflation is stuck above their 2% target. And now this oil shock threatens to push it higher. Fed Chair Jerome Powell has been very clear. They will not cut rates until they are confident inflation is moving back to 2%. But if a recession starts, they will have to act. This creates a lot of uncertainty for markets. Interest rate expectations drive stock valuations. When those expectations change rapidly, stocks swing wildly. That is exactly what we are seeing now. One week, Investors think rate cuts are coming soon. Stocks rally. The next week, inflation fears resurface. Stocks fall. This back and forth can continue for months. So what should you actually do right now? Here's my beginner-friendly action plan. First, review your asset allocation. What percentage of your portfolio is in stocks versus bonds versus cash? Does that match your risk tolerance? If you cannot sleep at night because you are worried about your portfolio, you have too much risk. Second, make sure you are diversified. Do not have all your money in one stock or one sector. Diversification is the only free lunch in investing. It reduces risk without reducing expected returns. Third, consider tax loss harvesting if you have losses. This is where you sell investments at a loss to offset capital gains. It can reduce your tax bill, but make sure you understand the wash sale rule first. Fourth, keep investing consistently. Do not stop your retirement contributions because markets are volatile. In fact, volatility creates opportunity. You are buying shares at lower prices. Fifth, educate yourself. Use this time to learn more about how markets work. Read about past crises and how they resolved. Understand the relationship between interest rates, inflation, and stock prices. The more you understand, the less scary volatility becomes. Let me close with some perspective. The stock market has survived 2 world wars. It has survived the Great Depression. It has survived multiple oil shocks. It has survived the dot-com crash and the financial crisis. It has survived a global pandemic, and it has always come back stronger. That does not mean every individual stock survives. Some companies fail. But the broad market, the economy as a whole, is remarkably resilient. The key is having a plan and sticking to it. Do not let fear drive your decisions. Do not let greed drive your decisions. Let logic, evidence, and discipline drive your decisions. Now, I want to be crystal clear about something. This video is for educational purposes only. I am not telling you to buy or sell anything. I am not your financial advisor. Every investment decision you make should be based on your own research. You should consult with a licensed financial professional who understands your specific situation. Past performance never guarantees future results. Investing always involves risk, including the risk of losing money. If you found this analysis helpful, subscribe to this channel. I break down complex market events into beginner-friendly explanations every single day. No hype, no clickbait, just clear, logical analysis. Thanks for watching, and I will see you in the next one.